Welcome, everyone. Thank you for joining us tonight. Lots of great information. Interesting environment we find ourselves in. Interest rates have had a big jump in 2022, puts you in a different environment when it comes to mortgage renewals, or if you're a first-time home buyer trying to enter the market. Lots of new challenges you did not have to face this time next year. So that's why we brought a specialist in. We've had accountants in the past, lawyers in the past. Tonight, bringing in a mortgage specialist to try to help answer some of those questions, provide some guidance to find your way through this new environment. But before we get too deep into that, we always got to make the lawyers happy. So you have our disclaimer right there on the screen. And throughout the event tonight, we do welcome participation. So whether you're on Facebook or YouTube, the comment section, just type in the question or your comment as you go. We can see those on our side and we're happy to address them. We want to make sure everyone leaves with some information they find of value. So use the comment section, put in your questions, put in your comments. We'd certainly love the participation throughout the evening. And we are going to get to all of that great mortgage information, Kevin. But first, a quick introduction here, a reminder of folks of the firm involved.
Yeah, I am Becker. We are Becker Orr Wealth Management. We are a member of Canaccord Genuity Wealth Management. We are the largest private independent advisor firm in Canada. We're a global firm. We are in the UK, we're in Australia, we have offices in the United States, and we manage assets near $1 billion. $100 billion, should I say, globally. So that's the main portion of what we are. We are also a member of what's known as the CIPF, the Canadian Investors Protection Fund. That's the insurance arm that all the big bank firms are also insured by. So it's the same scenario. We have this there so we can give you peace of mind with your investments that things are secure and safe, and you'll be happy with what's going on moving forward.
Yeah, so a little background on the firm. For those of you just joining us, we're doing a quick introduction before we hand things over to the mortgage specialist to dive into the details of interest rates, mortgages, first-time home buyer tips and programs. Quickly on our team, you can see all of us there, Kevin, myself, as well as Adam, Markar, and Alicia, and there are some part-time staff in addition to that. Our team, our promise to each and every client, it is commitment, clarity, and confidence. For us, commitment, that's all about communication. Folks need to hear from us. We need to make sure those lines of communication are open, especially in years like this where there's a bit of turbulence in the market. And if we do our job there, lots of communication should lead to clarity. Clarity of the goals, clarity of the objective. Most importantly, full transparency when it comes to fees, rates of return. So a high level of commitment, high level of clarity. The end result, confidence. Confidence in our team, in our process. Most importantly, we want folks to have some peace of mind and confidence with their financial plan. Talking about the financial plan, we do have a whole process we like to go through. A fitting analogy for tonight, we call it financial architecture, building that financial home, and tonight we're talking all about mortgages and first-time home buyers. But the analogy is if you are going to build a new home, well, you can't just zoom in on one decision. You can't just pick out the paint colors of the kitchen. You got to start with that foundation, then work towards a secure frame, and then worry about the interior. Same thing in the financial world. That foundation is normally your estate. It's your insurance needs. Then you get into the planning part in terms of retirement planning, tax planning, mortgage planning, which we're going to talk about tonight. And what you do there will influence the interior, which are the investments. So keep that in mind throughout the presentation tonight. And again, our guest this evening, mortgage specialist Adam Buss. I'll bring him on the screen. He's going to go through lots of information about the increases we've seen in interest rates, variable mortgages, fixed mortgages. What do you do? First-time home buyer, what are a few tips? Adam's going to cover all of that. So lots of great information coming up.
Excellent. Well, thank you guys. It's great to be here. Though when we do these presentations live and in person, you usually feed me dinner first, so I guess I'll be starting this evening. So thank you for that.
There's McDonald's afterwards.
Fair enough. Yeah, I'll get that on the way out of here. So as I mentioned, I am a mortgage specialist. So a couple of years ago, I partnered with the Castle Mortgage Group, so a team of brokers, got a fantastic back office, great support team. We work with about 20 or so different lenders to help clients like yourselves potentially get the right mortgage offering for what you need. So what is a mortgage broker? Mortgage specialist. So in Manitoba, we generally call ourselves mortgage specialists, but really it's the same idea. I work for you as the client to find you the best overall mortgage package. So that may include trying to get the best rate, the best prepayment terms, the best flexibility overall, looking at all the different options that exist that also go beyond rate, but keeping that in mind that we do want to get you a steal of a deal when it comes to your overall mortgage offering. Little disclaimer. So I am here as an independent mortgage specialist, independent broker. I am not here as a Canaccord employee. Any services that I provide are outside of Canaccord Genuity and its subsidiaries. So a little disclosure here to keep the lawyers happy on all sides. So as Kevin and Clinton mentioned, we always want to make sure that those folks are content. So mortgage and interest rates. So obviously it's been an interesting year to say the least when it comes to interest rates and what's been happening and the mortgage market, the housing market, and could be quite a stressful situation for a lot of people. So where are we at today essentially? So Bank of Canada tends to announce every now and again as to what's happening with the interest rates. So obviously, unless you've been living under a rock this entire year, you would know that every so often, quite often in the news, they're talking about raising interest rates in Canada. So we have raised our Bank of Canada overnight rate to 3.75% so far this year. They raised it by 50 basis points, so 0.5%, on October 26, 2022. So what does that mean? That means that anybody who is in a variable rate product, line of credit, variable rate mortgage, you likely saw your rate increase as a result of that rate change, as most lenders, big banks, credit unions will typically increase their rates when the Bank of Canada makes a rate announcement, okay? Their next announcement is coming up on December 7th of this year. So there is anticipation that there is going to be another rate increase. We don't know how much at this point. It could be another 0.5%. It all depends. So they're trying to really cool down inflation by raising the interest rates quite aggressively this year versus what may have happened in the past. So if we look at the past, what has happened? Are we in a quote unquote normal time period? So anybody who's bought a house in the last, well, for sure in the last year or two and had practically free money from the banks at interest rates generally under 2%, or even in the last, let's say 10 years, we've been in an extremely low interest rate environment. That is not necessarily the norm, okay? So, rates of 2%, 2.5% on the mortgage, historically, that is not necessarily the normal rate that most people will see when they're buying a house, when they're trying to afford their mortgage. If you see, in the past, this is following the Bank of Canada rate. So you'll see in 2008, after the financial crisis, they dropped rates rather dramatically to try to spur the economy, and it stayed low for quite a long time, then slowly bumping up a little bit, still under 2% for the Bank of Canada rate prior to 2020. And then obviously as a result of the pandemic, they did drop the rates. And now, we are in a rapid raising environment, as you do see from that dramatic steep line upwards, okay? So where are rates going to end up? Well, at the end of the day, we certainly don't have a crystal ball as to what is going to happen with the interest rates in Canada. It's all a matter of trying to calm down inflation. Obviously, we hope that there is an end in sight as to how high they're going to raise these rates. These are some predictions from some of the economists that are out there in Canada, just trying to say, well, where are we going to finish off the year at the end of 2022? And how do they see that number changing by the end of 2023? So, of course, there's a 1-year gap in there that there could be an additional roller coaster along the way, and not saying that that's going to stay flat. So some of these are mostly predicting another quarter to another 0.5% increase versus where we're at today, and likely that continuing throughout 2023, and then hopefully starting to subside thereafter. So it likely is going to get a bit worse before we get better when it comes to interest rates. So you'll especially feel that if you are in a variable rate product today. So that's talking a bit about variables, but what happens when it comes to fixed rates? So 5-year fixed rates are often talked about and often advertised as kind of the rate that most people are gauging as to what's happening in the market. So when we look at the rate trends and what's happening with the 5-year fixed rates, we often look to the Government of Canada 5-year bond to say, what's happening with that bond? Is it increasing? Is it decreasing? And that's going to typically impact as to what's happening on the 5-year fixed rates for mortgages. No, not because the bond is 3.45, or I think today it was 3.39. Does that mean that's what you're going to pay for a 5-year fixed? There's always a spread above that rate. I'm going to say it's in the 1.6 to 1.7% range. Above whatever the Government of Canada 5-year bond rate is generally what you're going to be close to when it comes to the 5-year fixed rates. So again, this has been a little bit of a roller coaster, kind of a natural progression, hitting a low point. It's kind of late 2020, and then slowly starting to creep up. So even though Bank of Canada had not yet started raising interest rates, the bond market was getting the indication that a rate increase was going to be coming. So as a result, they started pricing that in ahead of time. So I'm going to say it was at least about 6 months before the first rate increase was even announced that the bonds had some of that rate increase already pre-built in. So there was a time period there where there was a bit of a sticker shock between the fixed rate and the variable rate, and quite a gap in between those two. So when borrowers were looking at them, they would say, well, why would I pay 2% higher at that time to get a fixed rate versus taking the variable at that time, knowing that the rates here could change as time goes on. So a lot has happened in the last year, especially, but I'll use 2 different points in time as an example here. So where were we a year ago versus where are we today? So if we look at a year ago, prime lending rate was 2.45. Even since I typed up this presentation, it's actually 5.95 right now as prime today. So that's 3.5% more than where we were a year ago. Variable mortgage rate, you could get as low as 1.15% a year ago. Now you're around 5%. That is a dramatic difference when it comes to your mortgage payments that you're going to feel in the end coming out of your bank account. And the trend really continues across all the different rate categories. You'll see line of credit has increased. The 5-year fixed has gone up by about 3%, and all the other categories within there as well. I see Kevin has popped up to join me here.
Yeah, we have a question that's come along. Obviously, this is going to have an effect. $1 million homes, of course, are going to have much, much larger mortgage rates now. How is this going to affect the price of these homes going forward?
That is a great question to ask your real estate agent. But I would think that naturally, as there's maybe less people that can afford these properties, then the market price would happen to decrease. However, I don't know that for sure. But as that's probably felt already today, as people are shopping around in the market, they're going to notice that maybe there aren't as many crazy bidding wars, or maybe they could get a house under asking price instead of over asking price. A year ago, you were getting outbid by 10 different people for $100,000 more than what asking price was. Has that stopped? Has that not? I mean, as a buyer, you discuss that with your agent and see what's changed.
Sounds good.
Good question. Thanks, Kevin. So again, this has given us a rough idea as to how the rates have trended. So certainly between the variable and the fixed today, there's not necessarily a huge spread when it comes to that versus, a year ago, there was well over 1% difference between those 2 rate options. What's had a very big impact that you may not consider is when it comes to qualifying for a mortgage. So let's look at a borrower that would have come to see me about a year ago, and they're wondering what their maximum purchase price was that they could afford. So even though rates a year ago were, 2-3%, they had to qualify based on what was called the qualifying rate, which at that time was a 5.25. Okay. So at that time, they could afford a maximum purchase price of $400,000. Okay. Today, because rates have risen so much, 5.25 is not good enough anymore. So it's got to be their contract rate plus 2%. So now they have to qualify based on 7.19%. which means they can't afford a $400,000 house anymore. They can only afford a $340,000 house. So that itself is a dramatic change in their purchasing power just over a 1-year time period. They didn't take on more debt. They didn't have any change in their income situation. It's just based on the qualifying factors for a mortgage, how much could they afford based on that calculation? Clinton.
Yeah. Well, great information here. Again, please keep typing the questions into the comments section. We welcome the participation. One question we get frequently, specifically for first-time home buyers, is if they're going to qualify for a mortgage, maybe a pre-approval, what should they be expecting? Like, what is the bank going to look at? What kind of information should they bring? Really try to set expectations there for that whole process.
Well, I mean, when we do a pre-approval on our end through the Castle Mortgage Group, we want to do a deep dive into the client situation to make sure we're turning over the rock, so to speak, to make sure that there is no surprises and they can go forward with confidence when they want to go and do their house shopping. So we're going to look at their income. We're going to look at their credit history. We're going to verify their down payment exists. Those would be three of the big things. Is we want to see income. We want to see that you have the down payment saved. I think I have it on a later slide, but the down payment, if we're looking through an insured mortgage, which I'll explain a little bit later, is 5% down payment. So you have to have that in cash. Plus, you also need your legal fees, so your closing costs. So in Manitoba, that's again typically about 2.5% of the purchase price. So you got a budget to have about 7.5% of whatever you want to buy in cash. It makes a difference if you're self-employed or if you're on commission. Often those, they want to average out 2 years of income. So again, we might need 2 full years in that position before we can actually verify your income to qualify. Yeah. You want to make sure that you're not on probation for your job. And there is certain, time periods, or I should say percentages of income that we can use. So we do want to make sure that we're verifying it as accurately as possible so that, again, you can go forward and, we don't have to crush your hopes and dreams when it comes to buying a house in the end, because you found that house you really want, but you didn't necessarily go through that proper pre-approval process ahead of time.
Good. Well, great tips. Continue to ask questions, folks, and I imagine you'll dive a little deeper into some of those factors as the presentation goes on here.
Excellent. Good questions. All right, so let's recap here. So an impact on a variable rate mortgage. So let's look at a client bought a house a year ago. They were super excited, bought their perfect house. They got prime minus 130 basis points. So prime was 2.45 at that time, minus 1.3%. So starting mortgage balance was $400,000 over a 25-year amortization period. So back in 2021, they were laughing. They were paying 1.15% interest rate, and their monthly payments were $1,534 and change. Fast forward to this year, their interest rate has increased to 4.65%. So a dramatic increase. But what does that actually mean for their payment? That means to afford that same mortgage payment, they are paying $722 and change more per month to afford that same mortgage and that same house. So for those people that already maybe had a tight budget, they're purchasing at the maximum that was available to them, they might really be feeling that pinch today. Some lenders out there will increase their payment as the interest rate increases, so they would see this direct impact. Some lenders will not increase the payment along the way, and instead you just kind of get hit with it later on. And all of that $1,500 you might be paying today might just be going to paying interest versus actually paying down any of the mortgage. So certainly want to check with your lender if you have a variable rate and you have not seen your payment increase. You might want to check what's going on there to prevent any big surprises down the road. And again, reach out to your mortgage specialist to discuss the options that are available to you. Probably one of the most popular questions these days, especially in the last year, for sure this year. So rates have increased. What should you do now? Should you go to a fixed rate or should you stay variable? I mean, first off, there's not necessarily a catch-all phrase that I can say that is going to fit everybody in one category or the other. It really comes down to your individual comfort. And also, how much room is there in your budget? So today, if I had to make that decision as a purchaser advising a client, would say, okay, maybe today your variable rate is 4.65. So that means your payment today is going to be about $22.57. So simple numbers based on the situation, similar to the prior page. Or you can say, I don't want the unknown as to where my interest rate could go. I want to lock it in for a fixed rate. So just to recap, because I didn't cover this earlier, and it might sound like something obvious, fixed rate, 5.19%. It's guaranteed for that 5-year window. So you are in the bank are making a contract saying, I agree to pay this rate for that time period, and they agree that the rate is not going to increase on you. So even if the variable rate skyrocketed to a much higher percentage, that would not impact your mortgage rate until the time comes that you renew it after 5 years. Okay, so you do have a lot more certainty when it comes to how much would your payment get to, essentially, as the worst case scenario, and how much interest would you be paying along the way. Versus on the variable, it could get a little worse. It could also get better. So that really comes down to an individual comfort level. I'm sure Clinton and Kevin talk all the time about risk tolerance when it comes to the investment side. This is risk tolerance when it comes to your mortgage and how much you want for your cash flow variability. So important things to consider when it comes to that. So again, not necessarily a crystal ball. If you are leaning the variable rate, know that it could get a little worse before it starts to get better. With hopefully it does get better in the next year or two. That's what everybody is thinking and saying. But if I had a crystal ball, I would make a ton of money. And I probably wouldn't necessarily be chatting here today, but that is the case. Kevin's joined me again.
And we get another question here. It's coming around the lines of U.S. mortgages compared to, say, Canadian mortgages. Now, the Canadian mortgage is sort of a 5-year renewal. My understanding is U.S. mortgages can go, say, 30 years, and you don't have to worry about it. So, I mean, obviously, may not be as big a deal in the U.S. as it is in Canada.
Yeah, U.S. mortgages do operate differently. They do have, 30-year rates. They have, and then it does operate substantially different. Like in Canada, there are rates that go beyond the 5 years. There's 7 years, there's 10 years. Those are options that are on the table. I haven't looked at those rates in some time because nobody's asked about them, but they do exist.
Okay.
So if you do want to lock in some peace of mind that goes beyond the 5-year window, I mean, that is an option that is available. As for the U.S. side, I can't comment too much because I can't do U.S. mortgages, but they do exist, and there's very few people, or I should say lenders in Canada that would do a mortgage south of the border.
Okay.
Good. Well, a similar question here, Adam, is we're talking about fixed variable, and I imagine we'll get into mortgage penalties in a second, but if someone has a mortgage with one lender, are they able to transfer it? Is they able to port their mortgage from one spot to the next?
So when it comes to porting, usually porting we view as moving the mortgage from property A to property B that you own and staying with the same lender. So that may be an option. Every lender does treat it differently. Some lenders do not offer portability. So when we see out there and we got this great rate that's advertised from some lenders, it might be a no frills mortgage, which means they'll give you a slightly better rate, but you got no prepayment allowances. You can't move the mortgage to another property. It's extremely unflexible when it comes to terms and conditions. Can you move your mortgage from one lender to another? Yes, you can move it anytime you want to, but you got to pay a penalty, and you got to pay, discharge fees, re-registration fees. So there is cost to go ahead and doing that. And absolutely, sometimes it makes sense. And sometimes it's like, no, it's way too expensive to do that. So I'll go through that on the slide coming up.
Yeah, so devil's in the details. It really depends on the mortgage
details.
and on all the details of the contract.
Yes, absolutely. So certainly if that is something that you want to consider, again, look at the details, find out what those charges might be. When you are picking a lender, if you are thinking, well, I might move to another house in the next couple of years, how can I make sure that some of my options are open? You really got to pick your term carefully and also look at some of those conditions on the mortgage for portability to another property. And can
Sure.
your lender lend outside the province, right? If you're looking at maybe a
Yeah.
credit union, they
Mhm.
might be limited to just lending inside their province. So if you move to another province, they can't transfer that mortgage with you.
Good to
Good
know.
questions. All right. So as Clinton mentioned, so we'll chat about mortgage penalties. So what happens when you do break your mortgage term? So let's assume rates have dropped and you might want to take advantage of other options. So you have another 4 years remaining on your mortgage term. So you locked in at 5.19%, rates started to come down again, and you're thinking, oh geez, why did I lock in at that rate? I wanna pay a lower interest rate. I'll save money on my interest costs. It makes sense to me. What is it going to cost me to go ahead and get that done? So different ways of calculating the mortgage penalty. So there is a 3-month interest penalty charge, which is pretty simple. Interest rate times balance times 3 months equals approximately what your penalty would be. So 3-month interest rate penalty on a $400,000 mortgage in this example, $5,100. And then there's the big nasty one called interest rate differential. Now, every lender will calculate this slightly differently as to what comparable rate they use, and that can make a dramatic difference in your penalty charge. But we'll say for simple math, your rate was 5.19. The comparable rate to finish out your obligation, because you signed a contract with the bank to pay them 5.19% for another 4 years, they want that money as the difference. So the difference between these two rates, 1.4%. What is 1.4% times $400,000 times the 4 years remaining? And that is your big nasty penalty to get out of that mortgage. Okay, so keep that in mind when you see new rate opportunities down the road that you want to switch to. It could cost you an arm and a leg, okay, maybe even 2 arms if that's the case. So something that you do have to keep in mind. Beyond that, there's also discharge fees if you want to transfer somewhere else. There's new registration fees, might have new appraisal charges. So it does become less attractive to take advantage of those opportunities. Sometimes you can do what's called a blend and extend option with your current lender, which they basically just try to combine your old rate and a new rate and extend that term out maybe another year or two, just to, again, try to lower your borrowing costs and avoid a penalty charge. So things to look at when you are making those decisions and considering what that future flexibility has in store for you. All right, so some of the plans that exist today in Canada for helping people, especially first-time home buyers. So there is the home buyers plan for your RSP. So what are the requirements for this plan? Well, you have to be a Canadian resident. You cannot have owned a home in the previous 4 years. The money has to be in your RSP for 90 days prior to your withdrawal. So some people will say, I want to put up a pile of cash into my RSP now, get the tax savings, but I want to take it out right away for the home buyers plan withdrawal. It's possible, but you have to wait the 90-day window prior to the withdrawal. It does even have some timing to it for, proving where the money comes from before you even buy a house. So certainly something to discuss with your mortgage specialist. There is a dollar limit. So it is a maximum of $35,000 withdrawal from your RSP as a qualifying withdrawal to go towards, again, a qualifying purchase for your first home. That is a non-taxable withdrawal when you do take the funds out. The caveat is you have to repay the money back to your RSP over a 15-year window. Now, when you go to Clinton and Kevin on a year-by-year basis and you say, I want to put money back for my home buyers plan, it doesn't really matter. You just deduct it on your tax return saying X amount per year was allocated towards my home buyers plan, okay? I'll use simple numbers because I don't feel like doing mental math at this time of the day. But let's say you took out $30,000. You have to pay back $2,000 per year over a 15-year window. If you don't, that $2,000 is taxable in that particular year. And then you have to do the following year, the next payment again, okay? So it's not all taxable as one lump sum. But again, the motivation is that you put the money back into the RSP so that you have it for retirement down the road. Clinton.
Yes. Well, great information. We're talking first-time home buyers. I know there's a couple of programs, and we'll get to another one in just a second. But a few first-time home buyers are on the webinar now. Would you have some general tips, some things that could help out a first-time home buyer entering this kind of market?
Ooh. I mean, get pre-approved. Find out as to what you have at your disposal. Look at, perhaps even ignore what do I have to say that you can get approved for. Think about your budget. How much room do you truly have in your budget for a mortgage payment? When you're looking at that, you should look at the mortgage payment. You should look at the insurance costs, the hydro heating costs, house insurance, water, all the utilities that are required, life and disability insurance for the mortgage. You want to make sure that all of that is factored in, and you're not just comparing, well, I'm paying $1,000 in rent today, I can afford $1,000 mortgage payment, because that house has added cost to it. So even though I could tell you, you can afford, $1,500 a month, but your max budget, that you've calculated is $1,200 a month, you should know that that is the number that's right for you. And that would be especially true for people that, again, have bought a house in the last year or two and now have seen some rising costs from inflation, rise in interest rates. So some of those costs have naturally increased as a result. And if they overbought what they thought they could afford at that time, they'd certainly be feeling the crunch today. So know the numbers that you are comfortable with affording on a monthly basis.
Yeah, owning a home's not cheap, right? There's a lot more to it than just the mortgage, all those additional added costs that unfortunately come in. So have a plan. I think what I'm getting from there is what you're saying, Adam. You want to make sure you have a plan. So really think it through, not just the mortgage, but all the additional costs, and make sure it actually fits with the budget, get pre-approved, and then you can actually start looking at what would fit, what kind of house you'd get for that budget.
You bet. Yeah. Start with the budget numbers, as exciting of a task that is. I know what I'm asking people to do, so I get it. It can be quite painful, but that's an important step to do before going and looking at realtor.ca and looking at all the lovely houses that you wish you could afford, but maybe are outside your price range. So it's always good to kind of set that reality first.
Perfect. One more question came in, slightly different topic. We are going to do more for first-time home buyers, but we did have a question come up about Manitoba specifically. Home prices are dropping or somewhat stable in Manitoba. The idea being, can you offer a lower number than asking? Do you think that would be an option right now? I think it's more of a question for a real estate agent, but in my mind, we had lots of buying frenzies when people were having bidding wars, and I think you fast forward to today, at least what I'm hearing is there's a lot less than that, and some people are getting houses below asking, so I think it could be considered. What would be your thoughts on that, Adam?
Oh, goodness, it's a great question. I mean, I certainly would defer that to your real estate agent. Yeah. I mean, anytime you're looking at buying a house, certainly work with one of the wonderful realtors that are in the city, get their advice. I mean, I recently went through the buying and selling process myself, and without a realtor there, I think even though I would consider myself fairly knowledgeable in the whole realm of the process, they were absolutely a huge value add to making us, well aware of all the options when it comes to making the offer, when it comes to pricing, both selling of our house and buying another one. Huge advantage. So certainly lean on them. In the buying process. It shouldn't cost you anything because they get paid from the seller. So certainly get their advice in part of the process. In today's market, I would think that it might be possible, but they also may change their pricing model, right? So instead of pricing it super aggressively to try to get bids, they might price it closer to what they hope to sell it for, right? You might not get a tremendous number of bids, depends if it's offers in by. I don't want to kind of go down that rabbit hole too much because that's more of a realtor question and their license for that process. But certainly have a chat with them. And if you want to discuss your individual situation, by all means, reach out afterwards. Links will be on my website at the end.
Absolutely. So keep the questions coming, and we'll dive a little deeper into some programs available for first-time home buyers.
Okay, so as Clinton stole my thunder and mentioned this ahead of time, so tax-free first home savings account is coming up. So this was announced in the federal budget for 2022, new to come in 2023. Basically, another savings vehicle that can help people purchase a home and save the down payment. So a lot of the rules and intricacies of these programs have not completely rolled out yet. From what we understand, it's coming out sometime in 2023, likely not at the beginning of the year, sometime throughout the calendar year. We understand it's going to have a $40,000 lifetime contribution limit, $8,000 annual contribution limit. So you are limited, unlike the RSP program, provided you had enough room to begin with, as to how much you can put in on an annual basis. The contributions are tax deductible like an RSP, which is great. So that $8,000 you put in, you can get the tax break on those funds. Growth income withdrawals towards a qualifying first home are tax-free. So that operates like a TFSA. And when you take the funds out, there is no obligation to put the funds back, which is very nice. Okay, so that is quite huge. From what we understand, the contribution room can also carry forward. So if you don't have money to put in it in the first year, you can double it up essentially the second year and so on. So keep that in mind. You can transfer, I believe, from an RSP to the first home savings account. I think it's going to be called the FHSA, just because we love acronyms. And it should have the same investment options as a tax-free savings account. Again, a lot of these details are slowly trickling out, and once the program's officially released and out there, there'll be a lot more information on it. Home buyer's plan continues to be available. However, you cannot make both the first home savings account withdrawal and the home buyer's plan withdrawal for the same home purchase. So keep that in mind, that it's not like you can do $75,000 combined between both of these plans, okay? But when that time comes, certainly ask your advisor as to the options and what makes the most sense. All right, so we'll switch gears a little bit. We'll chat about insured mortgages and then conventional mortgages. So what is an insured mortgage? So in Canada, it goes through an insurance provider. So in this case, I'll reference CMHC, so Canada Mortgage Housing Corporation. So what their job is, it's a government entity, and their job is their mandate is to help people get into homes faster with a lesser down payment. So with as little as 5% down payment, you can get into and do a house purchase without having to save the traditional 20% down. So that certainly makes it more manageable. Still not necessarily an easy task in all markets, but to save that down payment requirement. You likely, as a result of being an insured mortgage, also qualify for the best rate, obviously on approved credit. But when lenders do advertise their rates, they're usually showing their best potential rate possible for that mortgage, which is usually if somebody's got good credit, meets all the requirements, and likely an insured mortgage. Because when it's an insured mortgage, CMHC takes a lot of that risk away from the lender. So they're willing to give you a better interest rate because they've transferred a lot of that risk off to an insurer like CMHC. There's a couple other providers in Canada, but I'll reference CMHC as that's the most commonly known one. When you do get a mortgage through CMHC, so certainly quite common, it does have to be approved by both the lender and the insurer. So the application goes to both CMHC and to your lender for approval and underwriting. So you have to meet both of their sets of criteria in order to get approved and to get the mortgage. Now, CMHC doesn't necessarily do this out of the goodness of their heart. They do charge a fee onto the mortgage to go ahead and help you with that process, which is a percentage of the mortgage amount gets added in. So all the way from about 2.4% to 4%. So 4% is if you put the minimum down payment of 5%. Okay, so they add an additional 4% as a lump sum cost onto your mortgage. So you don't have to pay that upfront out of pocket. That gets added into the mortgage and then part of your payments along the way. Okay, so again, something to keep in mind that gets added to the mortgage and forms part of your payment. Now, if we look at conventional mortgages, Kevin's here.
Yeah, I get a question. It may deal with a slide or two back, but somebody wants to know, they're new to Canada and they're not really familiar with the 5-year renewal process. Like, how does that exactly work? I mean, mortgages for a certain number of years, obviously, and why do we have to renew every 5?
Yeah, so when they calculate your mortgage, it is usually based on a set amortization. So saying you have 25 years to pay off this mortgage in its entirety. But every couple of years, the rate may change on you. So initially, you might start off with a 5-year rate. So that rate is only good for a 5-year window. After that 5 years, you have a lot of options at your disposal. You can say, I want to go for a 1-year fix. I want to switch to variable. I want to go for another 5 years. I don't like this lender anymore. I want to move my mortgage somewhere else. Because your term has come up at that point, you wouldn't have a penalty charge that you'd have to worry about. So those nasty fees that I talked about earlier, you wouldn't have to worry about those when you want to decide to switch, and go to a different product, go to a different lender at that point in time. So yeah, that is generally how the 5-year renewal process works. And it would be 3 years. If you went with a 3-year fix, it's a 3-year renewal process, right?
Yeah, so basically, as opposed to, say, the 30-year US one, it gives you a lot more options and negotiability for dealing with that over a longer period of time, as opposed to having to lock into one rate for that amortization period altogether.
Right, yeah. Okay, conventional mortgages. So this is the term that we use when it is not an insured mortgage. So your mortgage did not end up going through CMHC or equivalent insurer. You have 20% down payment or more. Rates can often be a little bit higher on these mortgages. You would think that the more down payment you put, the lower the rate might get. In this case, it's actually opposite, because now the lender is taking on that risk themselves instead of pushing that off to an insurance provider. So rates do tend to be a little bit higher. They can often range from about 0.2 to 0.4% higher as a result of it. You only need to get approval from the lender, not the insurer. And generally, an appraisal will be required on the property as well. So again, something to keep in mind if you're putting a larger down payment, you're making an offer on a house, well, the lender may need some time to get that appraisal done. Okay, so that may take a couple extra days as part of the financing approval process, which I don't really have that as one of my slides, but certainly when you do make offers, I encourage people to put a financing condition in there. It gives you the extra time to get your financing lined up. So even if we did a thorough pre-approval for yourselves ahead of time, it doesn't necessarily mean that the bank or the lender has approved the house that you're buying and the value that you're paying for it. So to protect yourselves, because that's what this is all about, and putting in those clauses, it's a clause protecting the buyer. We encourage you to put a financing clause. That gives us a couple days or a week to go ahead and get all the ducks in a row, re-verify any down payment, any page stubs as required, verify the house value, get the insurance company, CMHC, to approve the deal as well. Because the last thing we want to do is you have a surprise saying, you know what, we thought you were really solid as a borrower, but they don't see the house being valued where it should be, or they notice that there may be an engineer's report required. These are some extreme situations, but they do happen. So again, encourage people to put a financing clause in there. And again, discuss that with your mortgage specialist. Maybe that's me. Certainly happy to help discuss that. And of course, connect with your real estate agent. So mortgage approval process. Well, get pre-approved. And second, get pre-approved. And if we've made it to line number 3, why have you not been pre-approved yet? Certainly get that pre-approval process going. It is absolutely key to a smooth buying process and making your life easier and trying to get that house purchased. It's just dramatically smoother. Okay. Again, when we go through and do a detailed pre-approval, we're going to pull your credit. We're going to look at your income. We're going to verify the down payment. We have a thorough pre-approval application that is completed, so make sure that we are well aware of any potential snags along the way, and we can give you the right advice and a solid pre-approval when you go shopping. So certainly important things to do. Happy to get that process started with you and look at all those. All right, last couple slides I'm going to end off with, and then we'll have some additional time for some questions. So everybody's favorite topic, which is mortgage life insurance. So I'm not here to tell you that you need to get insurance from the lender for your mortgage. I am a huge believer that you should have enough insurance coverage at minimum to protect your debt. Okay. That can be through your mortgage lender, or you can look and get that elsewhere. Okay. You're not limited to just getting it through your lender. My standard go-to is trying to avoid the one from the lender, because I think there are dramatically better options that are available outside of the policies that are sold from your lender. This is one example because they had a nice handy marketing piece that happens to be from Empire Life. What's the difference when you own a policy yourself versus buying the one that the lender's selling you? Well, A, you own the policy. You get to choose the beneficiary versus the lender being in control of it. You can get higher face value than what the mortgage balance is. The life insurance payout, if you own the policy as a term life, does not go down as you pay down the debt. Okay. The ones you buy through the lender go down in value as you're paying off the debt. Your premium is not changing, but the death benefit that gets paid out does decrease along the way. A big one that people don't realize is if you go through a lender, most of those policies are post-claim underwritten, which means after you've died, they're going to underwrite the policy to decide if you should have been approved for it to begin with. Versus the policies that you can get as a term policy, it's underwritten up front. So once you're handed that policy, you know you're covered at that point moving forward, and you don't have any unexpected surprises for your family. And one of the other highlights is if you decide to move to a different bank, if you own the policy, you can take it with you to any mortgage, any other provider as time goes on. The coverage remains in place versus if the mortgage lender gave you the coverage and you decide to go to another bank, well, now you have to go and apply for new coverage at the other place. Well, what if your health has changed? You might not qualify for that anymore. So certainly a big consideration to factor in. And when we look at the pricing, so how does it compare if I own my own policy versus getting one through the bank? So this is again through Empire Life, gives a couple different options. When we're looking at a 25-year term policy for life and disability. So, we are wanting to make sure that both it gets paid out if you pass away and that your mortgage payments are covered if you're disabled. Yeah, you might have some insurance coverage through work for disability, but if you're only getting 2/3 of your wage at work, guess what? You still have to pay 100% of your mortgage payment. So why not get that covered and use the 2/3 of your salary at work to live off of to cover the other costs that don't go away? So this gives an approximate price breakdown for a couple of different age categories. Certainly happy to shop that around and find the best option, save you some money, get you a much better coverage that exists. And that's it for my presentation. I think we'll take any additional questions that there may be for now.
We do have a couple for you here, Adam. I'll quickly note a reminder, folks. Kevin and I with Canaccord Genuity, we don't offer mortgages. Adam through Castle Mortgage, he is the mortgage specialist. So please do reach out to Adam if you do have a review or want to go through your specific situation. He'd certainly be happy to help out. You can see his website there on the screen. One question did come up, and I'll throw it to you here, Adam, specifically about a mortgage broker. The question is a mortgage broker a good idea, or should they just contact their bank? I'll let you go into the pros and cons of dealing with a mortgage broker.
Well, first off, I'm going to be biased because I'm a mortgage broker. So
Yes.
Obviously the answer is go with a mortgage broker. I'm going to say it does depend. Like sometimes any quirky situations when it comes to things that are outside the box for approval, really questionable scenarios or credit history. Sometimes if you have a long-term personal relationship with your existing bank, it can be easier to go through an approval process there. Okay. But that again is limiting your options. When you go through a mortgage broker, I got 20 different lenders that I can work with, all kinds of different products. I don't work for the lender. My job is to work for you as the client to find the best solution. I don't care if it's bank product A, B, C, or D. It doesn't make a difference to me. I want to make sure that I can help you. And best of all, 99.9% of the time, my services are no cost to you, as I get paid a commission from the lender. There are the odd times for very, very special things that the lender does not pay a commission, and there may be a charge, but that would be disclosed up front to you. But 99% of the time, you don't have to worry about it. My services don't cost you a thing then.
There you go. So a good question. We've had a couple throughout the evening, so we'll stay on a minute longer to see if a few more questions come through. But again, if you do have mortgage-related questions, that's not really Kevin or I or Canaccord's specialty. That's certainly where Adam Buss would come in as a mortgage specialist. AdamBuss.ca. You can see it on the screen there. We're getting some compliments, super valuable information. So I'll pass that along to you, Adam, since you did the heavy lifting.
Yes,
for most of
exactly.
the presentation. We do have one more that came in here just before the buzzer. I'll read it out. Any recommendations for renewal of mortgage after retirement? So kind of the idea there, you're already retired now, you still have a mortgage, you're doing the renewal, issues that maybe people will face, what to expect. Any comments on that?
Again, it does depend on your particular situation. I would keep in mind that you may have potentially more limited cash flow in retirement. You don't have the regular paycheck coming in, or your retirement income might be lower. You might want to discuss with your lender, does it make sense to extend your amortization? Maybe you only had 10 years left on the mortgage, but maybe extending it back to 15 or 20 years just gives you more comfort in your cash flow on a monthly basis. So those might be things that you want to look at as well. It depends how that ties to the end goal for the estate values and et cetera. That's putting on my other hat as a financial planner. So, certainly chat about it with your bank, look at your cash flow, see what makes sense.
Yeah. So to summarize, you really need to plan for it. The question here did specifically mention a renewal 2 or 3 years after retirement starts. So it gives you a bit of runway to kind of work it into your plan. And potential issue could be the cash flow, right? If rates go up and the mortgage payments are a little more expensive, that could crunch your cash flow when it comes to retirement.
And again,
so
it depends on where your cash flow is coming from. It may be challenging to try to move it to another lender, because then you'd have to go through the full debt servicing approval process again at that stage, versus leaving it with your current lender. Here, just sign this one form, take the new rate, have a nice day, right?
Yeah. Okay. Lots of things to consider there. No more questions are coming in. We do appreciate everyone for tuning into the event. We like to host these on a frequent basis to get the information out there. And if you have more mortgage-related questions, please do visit Adam Buss, and we'll be back again soon with another webinar, everyone. Take care.
Take care.